By the first quarter of 2026, 25 million Filipinos had quietly transferred 153 billion pesos into digital bank accounts. The practice of burning cash for user acquisition has ended. The institutions that survived the initial rush operate today as disciplined, profitable entities. This mass migration of capital is concentrating liquidity into digital ledgers, moving funds out of traditional brick-and-mortar branches. With this volume of money shifting formats, anyone looking to maximize their yield in 2026 faces a specific choice of where to place their funds. A 153 billion peso deposit surge signals a realignment of depositor trust. Consumers are actively choosing virtual platforms over legacy banks to store their wealth. GoTyme scaled by blending physical access with digital convenience. By deploying a vast kiosk network, they drove a 150% surge in debit payment volume over the last year. Meanwhile, Maya Bank confided its transition from a simple e-wallet into a banking force, accumulating 68 billion pesos in total deposits. Behind this growth, Maya's parent company is preparing for a potential U.S. initial public offering that could raise up to $1 billion. These entities have matured past their startup phase to become permanent fixtures in the Philippine economy. The primary draw for retail consumers remains the high-yield deposit interest rates, which consistently outpace traditional banking offers. This chart compares digital bank rates. Maya starts at 3.5%, but monthly spending missions unlock yields up to 15%. Tonik offers 4.5% for passive savers and 8% for time deposits. GoTyme provides a flat 3% base rate without conditions. UnionDigital Bank positions itself similarly, offering time deposit lock-ins yielding up to 5.75%. Because these rate structures diverge so sharply, account holders have to select an institution whose algorithm directly matches their specific spending and saving habits. Paying out double-digit interest to retail consumers raises a question regarding how these platforms avoid insolvency. Tonik's achievement of standalone profitability in early 2026 provides the answer. They shifted focus from user acquisition to high-margin consumer lending. Look at this balance scale. Revenue from a single loan client is 20 times higher than a payments-only user. A digital banking license lets institutions source this retail funding cheaply, bypassing the expensive wholesale capital markets traditional lenders rely on. Those high deposit interest rates are the direct result of a lucrative algorithmic credit engine operating in the background. This lending model is currently navigating macroeconomic friction. Global inflation and Middle East tensions are driving up credit costs across the entire sector. Concurrently, the Bangko Sentral ng Pilipinas has initiated a crackdown on fintech companies attempting to bypass regulatory scrutiny. Some operators were using a loophole, purchasing inexpensive rural bank licenses to run nationwide digital platforms without maintaining the proper capital reserves. The central bank responded with a geographic threshold. If a rural bank sources more than 30% of its customers from outside its physical municipality, the regulator will intervene. Crossing that threshold triggers a forced reclassification, demanding a 1 billion peso capital injection within a strict one-year timeline. This tightening of the rules forces operators to prioritize systemic stability and strict capital adequacy over rapid expansion. Navigating this mature digital banking landscape requires matching your specific lifestyle to the bank's core profitability model. The active ecosystem spender should look to Maya, utilizing heavy daily transactions to access the 15% rate tier. The everyday transactor is better suited for GoTyme, leveraging its physical retail integration and flat deposit rates that require zero extra effort. The passive saver can turn to Tonik or Uno, utilizing their high-yield time deposits to lock in returns without needing to manage spending missions. While the regulatory crackdown continues, the underlying safety net remains intact. Deposits at licensed institutions are insured by the PDIC up to 1 million pesos. Evaluate where your emergency fund is currently sitting. Let us know in the comments below which digital bank offers the best strategy for your specific needs. Financial security in 2026 involves more than high interest rates. It requires a clear understanding of the economic machinery that generates them.